There's an old saying in trading that I think about often. There are old traders, and there are bold traders, but there are very few old, bold traders. Most people who get into trading believe something that feels completely logical. If I want big results, I need to take big risks. More risk should mean more reward. If I size up, I can grow faster. If I grow faster, I can escape my job faster. It sounds ambitious. It sounds confident. It even sounds smart. But in trading, that mindset quietly destroys more accounts than bad strategy ever will. What most traders don't realize is that trading big doesn't just increase potential profits. It amplifies every mistake, every losing streak, and every emotional weakness. And the market doesn't need many chances to exploit that. Let's talk about simple math first. If you risk 10% of your account on a single trade and you hit 5 losses in a row, which absolutely happens even to profitable traders, you're down close to 50%. That's not dramatic. That's just variance doing what variance does. Now, you're sitting there with half your capital gone. And here's the part that most people don't think about. When you're down 50%, you don't need a 50% gain to recover. You need a 100% gain. You have to double what's left just to get back to where you started. That's not a small hill to climb. That's a mountain. Now compare that to someone risking 1% per trade. 5 losses in a row puts them down 5%. Annoying? Of course. But they're still clear-headed. They're still thinking in terms of opportunity instead of survival. One trader is trying to crawl out of a hole. The other is simply continuing to execute their plan. That psychological difference is everything. The problem with aggressive sizing isn't just the math. It's what it does to your brain. When you risk big and win, you feel incredible. You feel validated. You feel like you finally figured it out. There's a rush that comes with it, and your brain loves that rush. So naturally, the next trade feels like another opportunity to press the advantage, and then you lose. And losing doesn't just feel bad. Studies on behavioral psychology show that losses hurt roughly twice as much as equivalent gains feel good. So when you take a big loss, your brain isn't calm and analytical. It wants relief. It wants to undo the pain. That's when traders start increasing size to make it back. That's the beginning of the death spiral. It's not bad analysis that kills most accounts. It's oversized positions mixed with human emotion. Even a solid strategy can't survive poor risk management. When you trade small, something subtle but powerful changes. A loss doesn't feel catastrophic. You don't feel the urge to immediately recover it. You can take the loss, log it, and move on. You're still in control, you're still rational, and rational decision-making is one of the most underrated edges in trading. I once watched 2 traders start at roughly the same time with similar accounts. They studied the same material, followed similar setups, and were equally competent at reading charts. One of them decided he wanted to accelerate the process. He risked 5% per trade because he believed his edge justified it. The other stuck to around 1.5%. 6 months later, the first trader's account had been cut in half. He wasn't incompetent. He just hit normal losing streaks at high size. The emotional pressure mounted. He started forcing trades. Sleep got worse. Stress increased. Trading began affecting his personal life. The second trader didn't have explosive gains. There were no massive screenshots to brag about, but his account grew steadily. More importantly, he slept fine. His drawdowns were manageable. He stayed consistent. Fast forward a few years, and the disciplined trader was still in the game, compounding quietly. The aggressive trader had either quit or was rebuilding from another blown account. The difference wasn't intelligence, it wasn't strategy, it was risk. Volatility makes this even more obvious. During extreme market conditions, crashes, panic selling, unexpected news, price can move faster than your stops. Slippage happens. Liquidity disappears. If you're risking 10% per trade and the market gaps hard against you, you can lose a massive portion of your account in hours. Traders risking 1% feel the pain too, but they survive it. And survival matters because markets recover, trends resume, opportunities return. The traders who preserved capital are the ones positioned to benefit from the next wave. Blown accounts don't compound. Professional money managers understand this deeply, and many hedge funds and institutional traders risk well under 2% per position, sometimes even below 1%. These are people with access to research teams, advanced tools, and decades of experience. They're not sizing aggressively because they understand that longevity is more valuable than a single big win. One large drawdown doesn't just cost money, it costs time. And time is the ingredient that makes compounding powerful. If you lose half your account, you might spend years getting back to even. That's years you're not building new highs, years you're not compounding gains, years of opportunity gone. Some traders argue that aggressive sizing is justified because of the occasional huge winner. If I risk big and catch a 10-to-1 move, I can double my account in one trade. And yes, that's mathematically true, but to catch that 10-to-1 trade, you have to survive long enough to encounter it. Trading involves hundreds, sometimes thousands of trades over a career. Losing streaks are part of the process. If your position sizing is too large, normal statistical variance will eliminate you before you ever see that outlier win. Small sizing keeps you solvent long enough to experience the upside. There's also something less obvious, that trading small provides psychological freedom. When no single trade can damage you, you don't feel desperate. You don't feel the need to move stops. You don't cut winners early out of fear. You execute your plan cleanly because you're not emotionally attached to the outcome of one trade. Over time, that calm execution compounds just like your capital does. You build confidence not from adrenaline-fueled wins, but from consistent discipline. You start trusting yourself, and that trust allows you to scale responsibly when your account truly supports it. Imagine starting with $10,000 and trading in a controlled, consistent way. You don't try to double the account in 3 months. You aim for steady growth. Some months you're up 4%, some months 6%, some months flat. Over a few years, that slow growth begins to stack. What once felt boring begins to look powerful. Aggressive trading rarely allows that timeline to unfold. Most traders who size too large experience repeated resets. They blow up, rebuild, blow up again, and eventually burn out. The market doesn't reward intensity, it rewards endurance. Trading small doesn't mean thinking small, it means thinking long-term. It means understanding that the goal isn't to win big this week. The goal is to still be trading 5 years from now with more capital, more experience, and more stability than you have today. The traders who succeed long-term aren't the boldest. They're the ones who survive volatility, survive losing streaks, survive their own emotions, and stay in the game long enough for compounding to do its work. A big risk feels powerful. Small risk feels boring. But boring builds wealth. And if you truly care about becoming consistently profitable, the question isn't how big you can trade. It's how long you can stay in the game. Because in trading, survival isn't weakness, it's the strategy.